The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. A lot of us have been in the situation buying a house. We've signed the papers for a 30-year mortgage and we've thought, how long is this going to take to pay off? How old will I be? Well, now imagine a 50-year mortgage. President Trump is proposing that. That's our topic for today. Philip Diehl and Brad Chastain join me now to talk about that. And Philip, I want to start with you as the 35th Director of the U.S. Mint and President of U.S. Money Reserve. Have you ever heard of something like this, a 50-year mortgage?
Well, only here in the last few weeks when it's gotten a lot of media coverage. 50 years is a long time, and that's a lot of interest to pay. I actually just bought a house in January with a 30-year mortgage. Well, I would be approaching Methuselah's age, paying all that mortgage, and I'm paying it down faster than that. But it's a lot of interest that amounts on a 30-year mortgage, and 50 years is it's really impractical for most people. It does lower the monthly payment. There's no question about that. Just like when you move from a 3-year car loan to a 5-year car loan. But when you start looking at the added interest that you pay for a car, that's really kind of a showstopper for a lot of people.
Brad, as the Director of Education at U.S. Money Reserve, you educate a lot of people. I don't think you've ever educated anyone about a 50-year loan before, but it seems like it could help some people at least get started to afford a house.
Yeah, that's the idea, that housing has become unaffordable for so many, and so spreading it out over a longer period of time reduces the payments. It was unheard of to me. I wasn't aware of it before this, but it actually isn't unheard of in the world. Other countries, they use them. Japan has them. Spain. Some other European countries use them. Some of them, in fact, including Japan, have 100-year mortgage, believe it or not, that are really designed for multi-generational financing, if you will. So it's not totally unheard of, but and to Philip's point, the amount of interest paid over that is substantial. But for me, the real thing is that it's more of a symptom of a bigger problem out there, that it is even up for the topic of discussion and seems to be some kind of necessary remedy out there. And that's that people are falling further and further behind. Incomes have not kept pace with the ability to buy homes. In 1985, the median home price for sales was about 3.5 times the median income level. Today, it's more than 5 times the median income level. And it's not just houses, but it's other things as well. We've seen for quite a while, it's become more in the forefront recently, but it's been going on for decades at this point, where we have this sort of separation in this kind of K-shaped economy, where those at the top are doing well, those down on the lower end are struggling. We heard the narrative a ton last year, 2024. Jerome Powell in the Federal Reserve meetings, anytime they would come out and announce their interest rates, was constantly saying the economy was strong. They were looking at all their economic, data, and reporters were consistently asking him about, what do you tell the average American? This is what the average American is saying. They don't feel that it's strong. And eventually he just started preemptively working it into his speech, saying, we see this strong economic data. We realize that everybody's not feeling the same way about it. And so this is really just a symptom of a bigger economic problem. It's not necessarily going to fix the problem. In fact, for overall housing prices, it doesn't fix it because it doesn't bring them down. It brings more people into the buying equation that can drive more demand for prices. But yes, to your point, the monthly payment may start becoming it within somebody's monthly budget, but long term, being able to build the equity and the wealth that so many people have historically relied on with their homes, it's going to ultimately end up with people further and further behind where previous generations have been.
Brad, I like what you say about how it may show signs that there is a problem, because the reason why 30-year mortgages actually became a part of history is because of the Great Depression. Because back then, apparently, house loans, home loans were only about 3 or 5 years, and then they became 30 years because of the Great Depression. So what's that telling us right now, Brad?
Yeah, the people are continuing to fall further and further behind, that trend is not reversed. I mean, we saw this with auto loans before the housing even, right? It used to be people would borrow money for an auto. It was, I think 5 years was kind of the standard for a long time. And now 6, I think, is more the most common, with some people doing even longer to get those payments down. And everybody knows how that's kind of different than a house, and that depreciates. And so people get more underwater in their auto loans when it's time to, trade it in for something else. So this has been going on for a while. We're just continuing on that trajectory, and this is another symptom of that problem.
Philip, don't you think this is something that you can't look at it like, okay, I'm going to buy this house and pay it off for the full 50 years. It's more of a case of someone who's a young homeowner or prospective homeowner. They can afford to buy it for a couple of years, and then hopefully they're going to earn some more money, refinance, and bring that mortgage length down a little bit.
Yeah, it's a very different situation. If you are buying a piece of property that you're going to live in and you expect an appreciation rate that's relatively high, certainly higher than whatever interest rate your interest is accumulating on your property, in those situations, it can make sense for a 30-year mortgage or even a 50-year mortgage if the numbers are right. But I think we're past those days of very rapid increases in housing prices. And so it becomes more and more of a burden, these longer term loans. Now, yes, if the circumstances are right, you might buy a house at with a 50-year mortgage, and then plan on moving up as your income increases, and if you expect the home to appreciate, then it can make some sense. But you really have to run the numbers close and be realistic about what housing prices are likely to do. I mean, we all know, we were taught the lesson from 2008. For 20 years before that, we were told that housing prices can never go down. And there were a lot of people who learned the hard lesson that indeed they can go down. And we've been seeing that in the last 2 years, where some of the hottest markets in the country have actually lost value. Austin, Texas is one, where housing values have fallen substantially. I've recently saw numbers as high as 25%, and that's on a nominal basis. If you include inflation in it, you're talking about a 35% or more decline in average housing prices in some of these markets. Other markets, we've seen appreciation rates continue to climb, and in many of them, they've just sort of held their own.
Brad, this seems to be a case where some people just have an opportunity to not pay rent anymore. They can buy a home. Money may be kind of the same, and you're not going to get much equity, but you will technically own the home.
Yeah, and that may be the case for many people. And so some people may benefit from this and be able to get into a home that wouldn't otherwise do. That's ultimately the intent. So I hope that people genuinely benefit on this. It's just that it is a patch to a bigger problem. Really behind the scenes. So that's happening, that is just not being fixed by this. It just kind of papers over the problem.
Yeah, I think Brad really makes an important point here, and that is, this is dealing with the symptom, the affordability symptom, and we have much deeper issues that need to be addressed. A significant increase in home construction in the right markets. There are markets in which there are plenty of homes. In some markets, there may be an excess of homes. But in much of the country, we need rapid construction of housing for people in order to make it affordable. We also need to see a decrease in interest rates, especially those 10-year Treasury bills, because those are the ones that drive mortgage rates. And it's really difficult to lower those rates when we have such a huge government deficit. And our debt is now $38 trillion. It's rising incredibly rapidly. It's hard to keep up with it. I've been saying 37 trillion, and and I updated that just a couple months ago, and now here we are at $38 trillion. So something has to be done about the huge deficits that we're running, and in order to deal with the housing crisis.
And those deficits, as we've talked about, the increasing debt and how that has to mechanically increase the money supply, because the money is loaned into existence in the first place with interest, and then it takes more money that has to come into existence to pay even that debt back. It has to grow. That has been one of the things that has led to this as well. Just the increase in and I think it's right. There's a term that has been around for a long time, but it's become more prevalent recently with the term debasement, the devaluing of currency itself. And I think it has a lot of the explanatory power to this, why people are falling behind. Because from the Jerome Powell economist perspective, you look at real incomes, which means inflation adjusted, they've risen over time. Real disposable income, which is what's left over after you pay taxes for all your spending and saving and all of that kind of stuff, has kept pace with inflation. So from that perspective, people should not be worse off. Yet, decades ago, there was a situation where you could have a family with one income earner working a blue-collar, perhaps factory job, who could afford to buy a house for the family and a car and take a nice vacation. And now that's not existent really much of anywhere anymore. You need a much, much higher income, and the vast majority of families need dual incomes, and an increasing number of dual income families are living paycheck to paycheck, in fact. And yet you look at it from the economic standpoint, wages have risen on a real basis. Real personal disposable income has kept pace with inflation. And so it's beyond inflation. The debasement idea also brings into asset prices. Housing, stocks, gold has been a huge beneficiary of that as well over the years, because that's one of the more fundamental currency alternatives, and it can't be debased the way that fiat currency, as we refer to dollars and yuan and yen, can be. So that term has gained a lot more prominence recently, and I really do think that it has a lot more explanatory power to why people are falling behind, rather than just looking at, am I keeping pace with inflation? And gold, and that's also one of the reasons why really since the late 90s, we've seen gold significantly outpace inflation. It's been much more in line with that overall debasement and loss of purchasing power, and it's helped actually maintain overall wealth, not just purchasing power. And so I think that hopefully will help kind of explain some of that dichotomy that we see.
Yeah, this is something that's really important, and Brad pointed this out to me. I did some analysis looking back over the last decade, in which I saw that over that decade, gold has outperformed stocks. It has outperformed stocks on an annual basis in 5 out of those 10 years, but over that entire 10-year period, it's outperformed stocks. And as Brad, demonstrated to me, gold has outperformed stocks over the last 25 years. And I think this gets into the whole debasement issue as well, that gold is outside of that debasement process, whereas other asset classes are subject to it. And so we're especially seeing that with stocks. And I think this really shocks people when they learn that that gold has outperformed stocks, not only just in recent years, but for a 25-year time period. And it's so crucial. That's so crucial for our friends and our family members and our clients to understand that it is taking your money out of the stock market in order to hedge your portfolio and to protect your wealth does not mean that you are going to lose the income that you might have from the stock market, because gold is increasing in its value faster than those stocks are, on an average basis. So I think that's sort of one of the myths that we see with our customers, is that their advisors are telling them, don't take your money out of the stock market. Yes, you're hearing a lot about the possibility that there's going to be a crash coming, but keep your money in the stock market, because if you put it in gold, then you're going to be losing those gains. And like I said, over the last decade, certainly in the most recent several years, we've seen gold outperform stock.
Definitely a safe haven, much more than a 50-year mortgage, I think. I appreciate both of you joining me today. Philip Diehl and Brad Chastain, thanks for joining us.
Thank you, Mike.
Thank you, Mike.
That's all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority Podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.